Hi, Jawad.
Is
Nice
it
to
better
meet
now?
you.
Yeah, it's
Yes.
perfect actually. We can hear you perfectly.
Yeah, nice
Awesome.
to hear you clearly, and nice to meet you.
Absolute pleasure. Thanks for having me.
You're very welcome. So I have your website up here, Straight Reflections. So this is where you are. I have an interest, and I read a little bit about you on your website, and you sound like a real Renaissance man. And I always say trading is what we do, it's not who we are. And I've noticed that's your story as well. Can you tell us about your early days looking at the markets and how you got involved in managing money and becoming a trader, analyst, market commentator?
Sure. So I've had a very unconventional background. I'm from Pakistan, born and raised in Dubai, spent half my adult life in Canada. So very multicultural in background. I went to university in Canada, and that's where I began my career. First job out of university, I was actually a bank teller. No one aspires to be a bank teller, but frankly, that was the best thing that could have happened to me at that time, as it allowed me within a bank to figure out what the different divisions of a bank does. And through that, very quickly realized that actually asset management is what sounded most interesting to me. So as soon as I figured that out, I was 20 years old at that time. I started reading as much as I could, Market Wizards from Jack Schrager, Stephen Drobny's remarkable books, as well as many others, to learn as much as I could. And I did my CFA examination, did my CMT examination, had a lot of senior traders and portfolio managers from the Toronto community sort of mentor me or spend time with me to improve my skill set. And then I moved back to the Middle East about 10 years ago, and I was primarily a proprietary trader across global markets. And then 4 years ago, I left to begin Straight Reflections, which is basically a global macro research and trading advisory. And that's basically a summary of whatever I've learned up to this point, what I continue to learn, and putting that forward for our clients in terms of structured thought around major investment themes and actionable trader ideas across multiple assets. So focusing on stocks, bonds, currencies, and commodities. So intermarket analysis is very important to us. Thinking deeply on multiple time horizons is important to us. We're not short-term traders. We like to live in the future and think about what the world would look like 6 to 18 months from now. So we bet on big moves on the back of that.
Okay. Yeah, kind of like Wayne Gretzky. He skates to where the puck is going to be, not where the puck is. So interesting journey that you've had. And yesterday on Twitter, you told me you really wanted to delve into what's happening with the U.S. dollar. And I posed this question to several guests that I've had. You know, we peaked at 104, and, you know, it was an ongoing bull market for quite some time. And a lot of people were surprised by the decline in the dollar. You know, I humbly say we weren't. But I'm curious if you view this as a secular change or a cyclical change in the direction of the dollar.
So the way we think about the dollar, or any asset class for that matter, is in terms of phases. So I think I could identify for you 3 phases within the equity market, 3 phases within the fixed income market, and similarly 3 phases within the dollar bull market so far. And just from a background perspective, I think it's important to understand where we are in that cycle. So I think the dollar reached a peak against major currencies in 1985 and fell around 52% to a major low in August 2011, which ironically coincided with the S&P rating downgrade. So the first stage of the dollar bull run since then simply corrected the negative sentiment and historic undervaluation. So from 2011 for the next year and a bit, that was the first stage. By mid-2014, then you've seen the Fed's divergent monetary policy, interest rate differentials, and growth trajectories favored the U.S. over other countries. And as this became the key investment theme for global investors, we saw the largest dollar rally on an annual basis in 30 years. And this was the second stage. And if you remember, everybody was talking about monetary divergence, and the dollar was just going to fly to the moon.
Yes, we were going to be, you know, sub-parity in the euro, et cetera, et cetera.
Exactly. And this brings us to December 2016, and then you've had the Trump win, and suddenly markets repricing as well. So these are the first two phases. And we argued that for the third phase, we basically need a new trigger or a new narrative for the uptrend, because the dollar is by now expensive by any measure. And because the Fed was the primary driver of the second phase, it can't be the driver for the third phase. So you need to have a new trigger. And if you remember, again, Dale, towards the end of the last year, a lot of people were seeing a stronger dollar as the clearest investment implication of a Trump win, because they were comparing back to Reagan's environment in the 1980s, right, and how you were going to have tight monetary policy and loose fiscal policy, and the dollar would just really soar in that environment. We took a contrary bet, I guess, much like yourself, coming to the same conclusion from a different angle. We felt the comparison with Reagan is not fair, because unlike Reagan at that time, I don't think Trump inspires a lot of confidence of global investors. And we were hesitant to believe that the U.S. could continue to attract the sort of portfolio inflows that were seen in the 80s, which led to the supercharged dollar bull market. So we actually argued that the dollar no longer looks irresistible to foreigners with Trump as president. And so technically speaking, around that same time, the DXY went to 104, just a little bit over what for us was a very important technical level, which was the 61.8 fib retracement of the entire 2002 to 2008 decline.
This
so
whole wave.
This
whole wave.
Yeah.
Right here, 61.8. Okay.
So our work suggested that when you hit such a significant level, you're pretty much into a consolidation correction phase for the next 6 to 9 months. So technically, we felt we were entering a consolidation correction phase for the next 6 to 9 months. But as we're mostly fundamental-oriented investors, we started thinking about what could result in a deepening of the dollar decline based on extremely crowded consensus positioning in long positions against in the dollar. So entering this year, we were short the US dollar in our portfolio around 95% of NAV. It's extremely, extremely short, and we were long euro, the British pound, and the yen in most cases. And just to review the thesis, because I think it's important to reflect on what the outlook was in January and where we stand today, because that will determine where we could end up, let's say, 6 months from now.
Yeah,
so
it's flipped 180 degrees sentiment, hasn't it?
Sentiment for sure, but I think what's also but I think what's also important is, apart from sentiment, which I think is an important tool, fundamentally, frankly, there's been major shifts that I think are less often discussed. So let me just summarize for you what was our bet at the beginning of the year, and then how the fundamentals stack up today. So we were basically aggressively short the US dollar all year, betting on the following 5 forces. Number one, we were expecting, unlike the divergence that we saw in mid-2014, we were actually expecting a convergence of monetary policy among the world's major central banks. Basically, you had a very well-articulated and predicted path of future Fed policy versus a sharp hawkish turn in other central banks' language and actions, which would put the dollar rally at risk. And then secondly, if you remember, expectations of President Trump passing his pro-growth agenda through Congress were running well above what we thought was practically possible. And we felt that once the realities of the American governing system set in and the faith placed in President Trump sort of subsides, so should the strength in the dollar. Because he's extremely
David Stockman was all over that view, the former budget director for Reagan. He said they wouldn't be able to get anything done. Yeah. Go ahead, Jawad. Interesting.
So that was another catalyst. Third catalyst for us, we were extremely convinced in our view that Europe will remain unified and that the populist forces will be defeated. So we felt if we get forces moving towards EU integration, and if Le Pen loses, then frankly this breakup risk premium that was embedded in the price of the euro for so many years would simply vanish. And you'd actually see money moving away from the US towards Europe. And that would basically help the euro rise, and by influence result in a weaker dollar. Alongside that, we were optimistic about global growth. We saw more synchronization in economic cycles, and that's usually supportive for EM carry trades. And again, that would mean dollar would be weaker, and you'd see risk-taking increase and emerging market currencies rally. Again, it's just funny how markets work, right? You've been in the business a long time to know that Trump railed on Mexico throughout his election campaign, and the USD MXN peaked around the time that he was inaugurated. And since then, we've seen Mexico strengthen. So that was the third reason, basically. We felt the defeat of populist forces in important European elections and better growth would lead to euro rallying and EM carry trades making them come back. And then fourth is something you alluded to, which is the bullish sentiment on the dollar. If you remember the Economist magazine in December with the greenback and that strongman sort of a suit, which was just showing how the dollar is going to remain strong here on forward. And then we combined that with extremely crowded long positioning at stretched valuations. And from our conversations with a lot of different hedge fund managers, it was pretty much the de facto Trump position for them. And we felt with speculators at the same time amassing a record number of short euro positions, again, the risk was limited to bet against the dollar. You couldn't stretch any further. And like I said, lastly, from a technical standpoint, we just felt the Fibonacci retracement would be a significant barrier in the short term to surpass. So again, it would help us cap our risk. So those were the five forces back then. Since then, we've seen, the trade weighted basically closed down 7 months in a row, sentiment at rock bottom. And let me just see or observe for you some of the fundamentals today as they are shifting. So a lot of people have belatedly begun shorting the US dollar because they just did not expect it to be so weak. And I think a lot of money has chased European assets after May when the pen actually lost. And a lot of macro managers, and I think this is probably interesting for your listeners and your viewers, a lot of macro managers that struggled in first half struggled because they were caught wrong-footed on consensus trades. And a lot of them are moving into Europe and the big European trade theme belatedly to make up for that lost performance, which is why you've seen this relentless bid in the euro. It just barely corrects and just keeps moving higher and higher. And we've seen that over the last few weeks. So now, let me put this forward for you, because right now, as of Friday, we actually started shorting the euro. We've been long USD CHF for about a month now, so we're up about 1% on our USD CHF position long, and we shorted the euro on Friday, so we're down about 60, 70 basis points on that. But let me just explain why we've flipped now from being extremely short US dollar to now gradually becoming bullish USD on the margin.
Okay.
And I would say consider the following, right? So from a Fed policy perspective, it seems investors want to interpret the Fed dovishly and the ECB much more hawkishly, with the market pricing only about 60 basis points between now and the next 24 months of tightening, which seems pretty dovish to us, unnecessarily so, frankly, because we think the Fed will deliver much more tightening over this period than what the market is currently pricing. I mean, the U.S. economy, again, people keep worrying about a recession, but we frankly think the U.S. economy is in a much more durable expansion. And the economic surprise index is most likely to be rising from here over the intermediate term. Meanwhile, if you look at Europe, it's still well behind the U.S. in its cyclical recovery. And any rerun of political risks with the Italian elections in 2018, for example, will force the ECB to remain accommodative, much more so than what people currently expect. Let's not forget the euro is already 8% stronger than what the ECB staff assumed just last month. And on a trade-weighted basis, it's within 3% of all-time highs. They just simply can't afford such a strong euro. And whereas let's realize that the unemployment rate is falling in Europe, it is still 2% above pre-crisis lows, and inflation is still squarely below the 2% target. So given sluggish wage growth and across most of the region and the lag effects of the stronger euro that we're seeing, inflation pressures will again dampen going forward. So from that perspective, relative even central bank balance sheets with the Fed unwinding starting probably in October would argue for a higher dollar versus the euro.
So let me just interject for a second here, Jawad. So are you looking at this when euro peaks for this just to be a corrective move of the advance we had from 103? or do you think that the dollar could recover all of its losses? So in other words, is this a trade, or is this your view that we could end up eventually within your longer term time horizons trade above 104 in the Dixie again?
So sometimes you don't have all the answers, right? And I think
great. You know what? That was a great answer.
So the way we think about it right now, we are open-minded. So we are open-minded to both interpretations. So we are open-minded to believing the dollar bull market can continue. And I think we've got fundamental reasons that I could argue for that to be the case. Because I think technically we're neutral. I don't think we can make a technical argument for the fact that the dollar bull market is over. And I can also make technical arguments that there's significant more upside left. So technically, I'm not getting any answers on a longer-term time frame. Fundamentally, though, I think there are answers to be had. And I think, like I said, you need a new narrative for the third phase of the dollar bull market. So based on our thinking, what will be that narrative? Two come to mind. One is rising protectionism, because rising protectionism is dollar bullish. So if we begin to see the U.S.-China tensions increase, and the U.S. And the White House focus more intensely on the trade deficit and wanting to close that, then that would argue that the dollar bull market will continue and we'll see new highs. Short term, what have we seen? Actually, them not moving in that direction, because the much debated border adjustment tax has actually been thrown out the door. So that would have been the immediate catalyst for you to see a very sharp dollar in the rally. So we've taken that off the table. But that doesn't mean they can't have protectionist measures in the future. It just seems unlikely over the next 6 months, let's say 12 months for now. That's one catalyst for a stronger dollar and a third theme or a third narrative. The other is widespread belief in Trump and him actually delivering on his growth proposals, right? So if he actually goes out and and boosts fiscal spending, and you do see much stronger growth, and you do see U.S. once again as a place where you want to deposit capital, then you could see a much stronger dollar. Now, the question is, fundamentally speaking, how will that be funded, and what will the market care about? So let's say he goes ahead and does what Republicans generally do, which is deficit-busting tax cuts. If the market begins to focus, and we don't have an answer because we won't until the market decides what it wants to focus on. If the market focuses on the strong growth and the fact that because of that strong growth, the Fed needs to hike faster and price in more normalization, you should see the dollar strengthen. But if the market focuses on the fact that, wait a minute, these aren't funded, it's going to really widen the budget deficit, and that is actually negative for the US. And if they focus on the deficit, then that actually means you're going to see a weaker dollar, right? So you're actually in a situation where we just have to wait and see. So we have to wait and see what policy will come forward. Would it be protectionism or spending? And then what would the market focus on and how it's funded? So we have multiple scenarios. We always operate with multiple scenarios. And whichever sort of makes most sense and ticks most boxes, we sort of go with that. And right now, I would say we're treating the dollar with our long positions as a counter trend move. So as a much more, let's say, a 3 to 6 month horizon. And we could end up staying longer in the trade, but we're not in a position today to determine that.
Okay, very interesting. And we have a little bit of time left. That was great coverage and, top elite fundamental analysis. Any other instrument or asset class you'd like to cover before we wrap up?
I think, I don't know if commodities is interesting for you guys or not, but I think oil is very interesting, and I'm the only guy I know who's bullish on oil prices, who has been so for the last 1 month. And I think we could see an oil squeeze coming, which could take oil prices well above $60 in the next 12 months. And there's fundamental reasons for that as well. I think a lot of people look at the charts and they think the charts are ugly.
Reasons too. There's your technical reason. Look at the screen. You have convergence of a few moving averages there, so we can learn from each other, right? And also, I have my cursor here, right here. This was a falling wedge formation, and 100% retrace takes it to 62. So I'm with you.
There you go. And I mean, looking at your chart just right now, it actually even looks like an inverted head and shoulders pattern if you want to, right? So
a lot of people thought we might get one more dip under 40 for the shoulder to develop a little bit more, but that's looking less likely. So do we have a continued blow off in S&Ps, Jawad?
So I am of the view that over a cyclical horizon, right? So on a cyclical horizon, I think there's significant more upside in stocks. Significant. I think 15-20% upside in stocks still exists on a cyclical horizon. I think what I also sometimes pay attention to technically is the Elliott wave theory and just counting waves. I'm a very simple technician, so very much relying on moving averages, trend lines, and Elliott wave counts. So if I look at the chart that you've just posted up for your viewers, I think we saw wave 1 from 2009 to 2011. I think wave 3 from 2012 to 2015. I think Q1 last year was the beginning of wave 5 to new highs, which is now super surpassed. And I think that wave can continue significantly higher because even though US has broken out, frankly, Europe is on the verge of breaking out. Japan has retested its breakout. So, I mean, I could spend hours discussing why I think technically and fundamentally stocks have significant upside. I do think over the next 3 to 6 months, though, we are completing, let's say, a minor wave 3. So you should see some pullback in wave 4. But that's probably an area where you want to buy as opposed to want to trade short, right? So I think that's significant. It's very easy to be bearish on stocks, but I do think the primary trend is higher for fundamental reasons as well as technical reasons. And I think you'll have more upside in non-US stocks than actually US stocks. I also have a very controversial view in that I think the secular bond bull market is over last summer. I think we saw a blow-off top last summer. And we've been bullish on bonds from December onwards, expecting a rally to continue through mid-year. We've sold about 2/3 of our long treasuries position at the end of June, but we've still maintained a few, like a third of our position. And that's basically because I think a lot of people are complacent about Fed actions in the fall. And the immediate reaction of what I think is going to happen over the next few months because of Fed balance sheet unwind is a tightening of liquidity. It's going to be weaker activity, economic activity. It's going to be weaker stocks and strengthening bonds in the short term, which is counterintuitive because you would expect that the Fed is unwinding its balance sheet. You'd expect yields to rise. But the market works in mysterious ways. And I think the immediate response, frankly, would be that bonds strengthen. So I think the next 3 to 6 months, the way we are currently positioned in our portfolio, for the next 3 to 6 months is we're short stocks. We're marginally long treasuries. We are long oil. We're long gold. We are building long positions in the dollar now gradually. So that's how we're thinking about it as of right now.
I'm really glad I reached out to you. And you're a great public speaker, and everything that it said on your website about you, you've demonstrated today. So I learned from you today, Jawad. So I really appreciate you coming. And
I appreciate it very much, Dale. Thanks for having me and putting your trust in me as well. And I hope your viewers benefited from our shared discussion.
Okay, well, we definitely did, and maybe we could get back together later in the fall, see how things are playing out and what narratives you're focused on. I encourage people to follow you. I think you have a great fundamental feel for what's going on in the market, and it was a great presentation. So they could follow you on Twitter at JS.Mian, M-I-A-N, and they could go to your website to check you out. And you guys are money managers, correct?
We're focused on mostly research and ideas. The money management is mostly internal. So we don't take external capital. We just focus on research and trading ideas from a business standpoint.
All right. Well, I'd like to call you from now on my trading warrior brother, Jawad, and may pips rain down. May pips rain down on you and everyone that hears your analysis. Thank you.
Thank you very much, Dale. Good day.
Good day. That's it, Face. Hope you enjoyed it. I thought it was a great interview. In my extremely accurate and humble opinion, remember, don't just count your pips, count your blessings. Click the link for the trial so you know what Grega, I want to thank Grega. You know, Grega, the Wizard of Ways, came in here, gave you some looks. In Aussie, Euro Yen, Steve Volge, as usual, he's our Iron Man. No matter what's happening in his personal life, he never deserts his post. And who said the summer was going to be slow? It doesn't slow down bees, especially worker bees like you and Face. So don't just count your pips, count your blessings. We'll see everyone tomorrow for the BOE. Adios, my trading warrior brothers and sisters. Enjoy your summer day. You're welcome, Doug. Thank you, Jess.